My personal equity risk premium stock valuation method by me, Max Sirius. My margin of safety price is the 10-year US Treasury Note Yield plus 300 basis points or 3%. And I compare that margin of safety yield to the stocks I analyze free cash flow to enterprise value yield. As an example, if hypothetically the 10-year US Treasury note were to yield 2%, I would not want to buy a stock that has a free cash flow to enterprise value yield of below 5%. The higher the 10-year US Treasury notes yield moves, the higher I want an investment's free cash flow to enterprise value yield to be. I also make sure that the company is using sufficient amounts of its operating cash flows for capital expenditures to grow its business and/or to stay competitive in its industry and sector. Telecom companies generally have maintenance capital expenditures of 14 to 15% of revenues, and they are the most capital intensive. So gross capital expenditures for a company in the telecom industry should be running between 16 to 18% of revenues for it to stay competitive with its peers. The free cash flow to market capitalization yield indicates an investment's risk to reward ratio. The best investments, in my opinion, offer high free cash flow to enterprise value yields, which indicate a high margin of safety, high free cash flow to market capitalization yields, which indicate a favorable risk to reward ratio, and high earnings before interest, taxes, depreciation, and amortization to revenue profit margins, which offer an additional financial safety and flexibility buffer to a company's operators and owners, i.e. shareholders. I recommend to avoid stocks that have high free cash flow to market capitalization yields, but low free cash flow to enterprise value yields, as illustrated in the following valuation example of General Electric from 2009, because it indicates that the company has a high debt load and has to also pay high interest expenses, which increases financial risk and decreases financial flexibility and liquidity. As an example, the table shows the free cash flow yield for 4 large market capitalization companies and their PE ratios in the middle of 2009. Apple sported a high trailing PE ratio thanks to the company's high growth expectations. General Electric had a trailing PE ratio that reflected a slower growth scenario. Comparing Apple's and General Electric's free cash flow yield using market capitalization indicated that General Electric offered more attractive potential at this time. The primary reason for this difference was the large amount of debt that General Electric carried on its books, primarily from its financial unit. Apple was essentially debt-free. When you substitute market capitalization with the enterprise value as a divisor, Apple becomes a better and safer choice. The bottom line, free cash flow yield offers investors a better measure of a company's fundamental performance than the widely used PE ratio. Investors who wish to employ the best fundamental indicator should add free cash flow yield to their repertoire of financial measures. Like any indicator, you should not depend on just one measure. However, it is appropriate to employ measures that give you a fair picture of the fundamental performance of the company you are considering. Free cash flow yield is one such measure.